Chapter 13 is Segment and Interim Reporting, and Learning Objective 13-1 is to understand accounting issues associated with segment reporting, both in the United States and internationally. And the issue here is really that companies oftentimes have many operations. They don't just do one thing. And oftentimes those things are very different, and they may be in very different places. They're very different ways of making money. And if you were to consolidate them into a single income statement and a single balance sheet, really a single set of financial statements, then all of what makes each company unique would be lost, because you'd just be combining it into a kind of a mishmash, a kind of a hash of just whatever's laying around. And you would not be able to understand the individual businesses. So what FASB, in its wisdom, does is it requires companies to break these things out into what's called operating segments. And operating segments are basically different lines of business. And what the FASB wants companies to do is to have the right number of operating segments. The thinking is that if companies report too many different businesses, that investors will have information overload. They'll just be overloaded with information and they won't know what to do with it all. On the other hand, if companies provide too little information, then there won't be enough information and investors won't be able to figure out what's going on. So what the FASB wanted to do here was to encourage companies to have a reasonable number of segments, let's say 4 to 6. And they might have fewer, but definitely to try not to go above 6. And to try to set things up so that little segments are sort of lumped together into something more meaningful. And so the FASB wrote section ASC 280, and it defines an operating segment like so. The component unit's business activities generate revenue and incur expenses, i.e., these are profit centers, including any revenue or expenses that's in transactions with other parts of the company. So each one is a profit center. By definition, a segment cannot be a cost center. And it could be an investment center too, but it's not going to be a cost center, and it's not going to be exclusively a sales center. Now you could have kind of a sales revenue center if you can allocate the expenses, but you definitely cannot have a cost center. The component unit's operating results are regularly reviewed by the entity's chief operating decision maker, who then determines the resources to be assigned to the segment and evaluates it. In other words, this operating segment reflects what the company actually does. In other words, this is a segment of the business that management thinks about, that looks at closely when they make decisions. And finally, that separate information is available. So those are the 3 components that we look for when we define a segment. And these are pretty broad components, but let's talk about what they would exclude. They would exclude cost centers. This definition also excludes parts of the company that management doesn't really think about. What that means is that you can slice and dice a company certain ways, but for purposes of segment reporting, you can't slice and dice a company into a piece that management itself does not consider a piece when they make decisions. And finally, so let's say a company has stores all over the country, and you say, well, let's make each region, let's divide it into 5 regions. If management doesn't use those 5 regions to make decisions, then those aren't really segments. And finally, that information is available. If the information is not available, then you're not going to use it. Information is available about almost everything, but this is designed here to exclude like crazy allocations. If you have to allocate everything to determine what the segments are, then chances are it's not really a segment. Some of your issues here are corporate headquarters is not a segment because it's really just a cost center. And companies can choose to combine several different segments, or aggregate them, if you will, if they're very similar. Because we want to get down to an ideal number of segments, and that's like 4 to 6. And so if you have 12 segments that the company really uses, then what you would do is you would combine some of the segments together that happen to be similar. And it's perfectly reasonable to allocate costs to specific segments as long as you don't go overboard. If the cost allocations are so frequent that they lose their meaning, then obviously that's not meaningful. And in international reporting, financial reporting standards, you have IFRS 8 has the information about the rules for segment reporting. And it's fairly similar to those of US GAAP.